This is a continuation of the July 24th class presentation, and in this continuation we're going to be continuing with cost volume profit analysis. So let's go to the first slide. And this is one of the slides that I said I would redo for everybody. And actually I split this now into two slides to make it a little bit more understandable, but let's go on to the first slide. Okay, cost volume profit analysis, and it's a concept of contribution margin. Contribution margin is an extremely important concept in management accounting. It's also carried through to the CPA exam. The contribution margin itself expresses the contribution margin of one unit. So what is a contribution margin? Okay, the unit contribution margin is the amount remaining after paying for the variable cost of production and selling the item. The remaining amount then is available to, number one, cover the entity's fixed costs, and then number two, after we've covered those fixed costs, then it will contribute to the net profit of the entity. Now, the calculation of the unit contribution margin is fairly simple. It's our selling price per unit minus our variable cost per unit. That equals unit contribution margin. Or if we want to write it out as an abbreviated equation, it's selling price minus variable costs, and these are per unit, equals our contribution margin per unit. Now let's illustrate contribution margin, the calculation in action. Acme's sale price for a product is $10 a unit. The variable cost to produce and sell each unit is $4 a unit. Fixed costs for the company are $12,000. So what is Acme's net profit at a volume of 10,000 units? So we can insert this now. We can use the contribution margin in a cost volume profit equation and do the calculation. Okay, the first thing we want to do is we want to calculate the contribution margin from the information above. We have a $10 selling price. We know that the variable cost to produce and sell the units are $4. That means we're going to end up with a contribution margin of $6. And what that is saying is for every unit produced and sold, $6 is available to, number one, first cover the company's fixed cost, and then number two, contribute to the net profit of the entity. So now let's plug this into the cost volume profit equation. We start out with our contribution margin now of $6. We multiply that times the 10,000 unit volume. So that means our total overall contribution margin, and again, forgive me for my writing, is $60,000. Okay, minus our fixed cost of $12,000 equals a $48,000 net profit. And we can see our contribution margin first covers our fixed cost, and then it contributes to our net profit. So we end up with a total of $48,000. Okay, now let's go on and expand the concept of contribution margin into another presentation or representation of the contribution margin. Okay, again, we're going to be, or I shouldn't say again, but now we're going to call this contribution margin not a unit, but a contribution margin ratio. Okay, also it's also referred to as contribution margin percentage. So if we say contribution margin ratio, contribution margin percentage, it means the same thing. Now, the equation to calculate the contribution margin percentage is just a small, it's adapted from the contribution margin ratio. Again, it's our selling price per unit times our variable cost per unit divided again by the selling price per unit. So the contribution margin is, in effect, a percentage of the selling price. So if we take a look at, again, if we abbreviate the equation, it's selling price minus variable cost, which in effect is our contribution margin, divided by our selling price equals our contribution margin. That should be percentage, not parentage, percentage or ratio. So let's go back to that former problem that we had just completed, doing the calculation per unit contribution margin. We're going to use pretty much all the same data here. Acme's sales price for a product is $10 a unit. The variable cost to produce and sell each unit is $4, same as the previous example. Fixed costs are $12,000, again the same. Now, using the contribution margin ratio, what is Acme's net profit at a sales level of $100,000? So instead of being given unit volume here, we're given sales dollars. So now the easiest way to do that is by doing it through the contribution margin ratio. So we take our $10 selling price minus our $4 variable cost. That gives us a contribution margin of $6. We divide that by our selling price of $10. So that means we have a 60% contribution margin ratio, or contribution margin percentage, depending upon what you prefer to call it. That means that the contribution margin of the company, every time we sell something, 60% of that selling price remains to cover our fixed cost and also to the net profit of the company. Now we can express that in a cost volume profit equation. We take the $100,000 of sales that we said we had achieved times the 60% contribution margin ratio. We subtract out those $12,000 fixed cost, and that means we end up with a net profit of $48,000, which is exactly the same amount that we had achieved, or that we had calculated rather, in the previous slide. And that's not surprising because we're using pretty much all the same data. Okay, now with that, we're going to go to a question again that I hacked up yesterday that I've revised, and it's a little clear. Well, it's completely clear now as opposed to the way I had written it. And it was question number 7. Widgets sell for $110 a unit. And the following is an analysis of the cost of making one widget. And you're given various production costs, or product costs, and period costs. And it's asked, what is a unit contribution margin? So we're looking for unit contribution margin. So it's going to be one of those 4 choices. Go ahead and you may want to stop the video. Then when you're ready, restart the video and review the answer. Okay, the answer to number 7. Widgets sell for $110 a unit. The following is an analysis of the cost of making one widget. And the answer in this case is A. The unit contribution margin is $10. And here's how we do the calculation. Direct materials and direct labor are always going to be variable costs because direct materials are incorporated into the product, and direct labor is directly related to producing the product. So those are pretty much going to be normally all variable costs. So we're going to include those as part of the process. Okay, then variable manufacturing overhead, again, that's a variable cost. So therefore, we're going to include that in our variable cost. Then we look for any other costs that are variable, and we see variable period cost at $10. So we include that. And after that, we don't see any other variable costs. So we add up those costs, and they come up to total variable cost of $100. Okay, we know our selling price is $110 a unit, minus our variable cost of $100, which we just calculated above. equals the contribution margin then of $10 a unit, and that is our answer, $10 a unit. Okay, let's go on now and take a look at let's go over some cost, volume, profit formulas that you should know. They can be broken down into two major categories. One category being unit volume, where all our solutions are expressed in terms of units of volume. And the other one is dollar volume, where all our solutions are expressed in terms of sales dollars. So let's start out with the first unit volume formula, and it's called break-even point in units. Break-even point means where my total revenues equal my total expenses, so my net profit equals 0. Any volume below the break-even point, I'm losing money. Any volume above the break-even point, I'm actually making money. Now, the calculation is actually fairly simple. It is total fixed costs divided by our unit contribution margin. And if you remember from previous slides, our unit contribution margin is our unit selling price minus the unit variable cost. So if you'll remember, what I had mentioned is when we talked about the unit contribution margin, that represents the amount that is remaining after we produce and sell an item that is available to cover fixed cost and then net profit. So in this case, what we're saying is, okay, if our unit contribution margin is first going to cover our fixed cost, if we divide the unit contribution margin by our total fixed cost, that'll give us a number of units that are required in order to break even. Now, let's take that same formula and add a little sophistication to it now. Now we're going to do what we call target net income in units. So what we do is we start out with the break-even point formula, which is our total fixed costs. We'll see later on they're divided by unit contribution margin, but before we do that, we take our total fixed cost plus we add in our target net profit. In other words, the money, the net profit that we want to make after our fixed costs. Again, if we recall again, our unit contribution margin is the amount that remains that covers our fixed cost, then our net profit. So we take our total fixed cost plus our target net income and we divide it by our unit contribution margin, and we get our target net income in the number of units it's going to take to achieve that target net income. Now we're going to take that exact same formula and we're going to add one other layer of sophistication to it. Target net income after taxes in units. So this is basically how many units am I going to have to produce and sell in order to cover my fixed cost and earn a target net income after I pay my taxes. So again, I take my total fixed costs and I'm going to add in again my target net profit, the net profit I want to achieve, but I need to adjust that by the amount of taxes I'm going to have to pay on that net profit. So it's target net income divided by 1 minus the company or the entity's tax rate. When I do that calculation, it'll give me the amount of pre-tax income I'm going to need in order to achieve my target net profit rate after taxes. And these quantities again are divided by my unit contribution margin like the other two formulas. Now let's take a look at dollar value or dollar volume formulas. What you're going to find is that these dollar volume formulas are pretty much derived exactly from the unit volume formulas. The difference is, instead of using unit contribution margin like we did in the formulas here under unit volume, What we're going to do now is, instead of unit contribution margin, we're going to substitute the unit contribution margin ratio in each of our formulas. So that's the one thing that's going to change. Now, if we substitute the unit contribution margin ratio, what that's going to give us is a dollar value, typically sales value. As an example, here we now are being asked, okay, what is my break-even point, just like in that first formula above, but in sales dollars. So I know right away that I do not want unit contribution margin. I'm going to want to do the calculation using the unit contribution margin ratio. Well, the calculation again is fairly simple. It's my total fixed cost, just like that first calculation under unit volume, but instead now it's divided by my unit contribution margin ratio. And again, remember, the unit contribution margin ratio is your unit selling price minus your unit variable cost divided by the unit selling price. So it's going to be percentage. Now we're going to do target net income, and we're going to find out that target net income is pretty much the same as the target net income formula in units, but now it's going to be target net income, but in sales dollars. So we take our total fixed cost plus the target net profit we want to achieve, and we divide that by our unit contribution margin ratio again. And that will give us our target net income in sales dollars. Now we're going to add the sophistication of sales dollars, basically net profit in sales dollars after taxes. So again, in sales dollars. So we take our total fixed cost, like the previous formula, plus our target net profit that we want to achieve. Then we divide it by 1 minus the tax rate to adjust it up to the amount of target net profit we're going to have to earn based upon our tax rate to achieve that target net profit. And that's divided by our unit contribution margin ratio. Now, the last calculation, it is a little different. It's called the margin of safety. And the margin of safety is basically the amount of sales that a company is at or that it wants to achieve minus the break-even point. And so margin of safety really is kind of a cushion between your present or your predicted sales and your break-even point. It says, you know, at what volume can your sales dollars drop before you hit the break-even point. Now, to calculate the margin of sales, you're typically given the amount of sales, or you may have to calculate it. But the important thing is that we say amount of sales minus break-even point in sales. So that means you're going to have to calculate the break-even point in sales dollars in order to do the margin of safety. So with that, again, these are good formulas to memorize, and when you think about it, they are nothing, you know, the target net income after taxes or target net income are simply additional sophistications of the break-even point. And that's either in units for unit volume or in a contribution margin for a dollar volume type. So the formulas are pretty much the same, whether they're unit volume or dollar volume. It's just a matter of substituting unit contribution margin versus the unit contribution margin ratio. Question number 11. Redstone Production sold one product. The product had a selling price of $40 a unit, and it costs $30 to make each unit. So that's our variable cost. Total fixed costs were $900,000. Redstone had a 20% tax rate. So the question is, what amount of sales volume, if you will, what amount of sales must be achieved to earn a $200,000 net profit, but after taxes? So go ahead and stop the video, do your calculations. When you're ready, restart the video. Okay, number 11, again, Redstone Productions sold one product, and the product had a selling price of $40, a unit cost of $30. Total fixed cost $900,000, and the company has a 20% tax rate, and they're asking what amount of sales volume is necessary to earn a net profit of $200,000 after taxes, and the answer in this case is C, $4,600,000. And what we do is we use the sales volume formula for a target net profit after taxes, which is our total fixed costs plus our target net profit divided by 1 minus the tax rate, divided by then that quantity, our unit contribution margin ratio. Now, if we substitute the amounts into the formula, we have fixed cost of $900,000. We have a target net income of $200,000, and we have to adjust that for the tax rate. So it's going to be 1 minus the tax rate. The tax rate is 20%. So 1 minus the tax rate, 20 basically, and we divide that into target net income. Then we're going to divide that amount by the contribution margin ratio, which is our selling price of $40 minus the variable cost, or the cost to make each unit, of $30. And we divide that again by the $40 selling price to get our contribution margin ratio. So when we break this down, we show $900,000 of fixed cost plus $250,000 of target net income, and that's the $200,000 divided by, in effect, 1 minus the tax rate, which is 0.8 or 0.80 if you will. So we 200,000 divided by 0.80 comes up to $250,000. So we're going to take that quantity, $1,150,000, and we're going to divide that by the 25% or 0.25 contribution margin ratio. When we do that, that equals $4,600,000 in sales. So that's the answer to this formula, or the answer to this question. Okay, now let's try another. Black Cat Productions sold decision cubes. Each cube had a selling price of $50 a unit and cost $30 to make each unit. The total fixed costs were $900,000. And instead of, for some reason, I left out Black Cat, it should be, I say Redstone had a 20% tax rate, that should be Black Cat. So how many units of product must be sold to earn a profit of $500,000 after taxes? So again, stop the video, do your calculation, then restart the video. Okay, Black Cat Productions sold decision cubes, and each cube had a selling price of $50 a unit, and it cost $30 to make. Total fixed costs were $900,000, and the company, Black Cat Productions, had a 20% tax rate. And the answer in this case is to earn $500,000 net profit after taxes, 76,250 units. So what we want now is we want our target net income after taxes, but in units. So we take our total fixed costs. We're going to add to that then our target net profit adjusted for the tax rate that we're going to have to pay, divided by our unit contribution margin. And that will give us the number of units. So we take our $900,000 of fixed costs from above. We know we want to earn a profit of $500,000, But first we have to adjust that for our income taxes. So it's $500,000 net profit divided 1 minus the tax rate, 20%, then divided by our contribution margin, not our contribution margin ratio in this case, but our unit contribution margin, which is $50 selling price minus a $30 variable cost. So these amounts then come out to, in this case, 900,000 plus 625,000, which is $1,525,000. Divided by our contribution margin of $20 per unit means that we need to be able to produce and sell 76,250 units in order to earn a net profit of $500,000 after we pay our taxes. Let's try number 13. Redstone Productions sold one product. The product had a selling price of $50 and it cost $30 to make each unit. Total fixed costs were $900,000. Redstone had a 20% tax rate. Now in this case, it's asking not in terms of units volume, but it's asking amount of sales. So what amount of sales must be achieved in order to earn a $500,000 net profit after taxes? So again, we're given our choices. Go ahead and do your calculation. When you're ready, go ahead and start the video again. Okay, number 13, the answer. Redstone Productions sold one product. The product had a $50 selling price. It cost $30 each to make. Fixed cost $900,000, 20% tax rate. And what amount of sales must be achieved to earn a $500,000 net profit after taxes? And the answer in this case is $3,812,500 worth of sales volume. And again, we take a look at our formula in this case, and it's literally going to be the same formula we used on the previous question. The difference is instead of using unit contribution margin itself, we use a unit contribution margin ratio. So we take our total fixed cost plus our net profit adjusted for our tax rate and then divide it by our unit contribution margin ratio, which again is our selling price minus variable cost divided by the selling price. So when we do that, we take $900,000 of fixed costs again. To that, we add our $500,000 of net income that we want to achieve, and we adjust it by our tax rate, so 1 minus the tax rate. Okay, divided by our unit contribution margin ratio, which is a $50 selling price minus the $30 variable cost divided by the $50 selling price. So now we have the $900,000 of fixed cost plus now the target net income. We have to achieve a $625,000 target net income in order to achieve a $500,000 final target net income after taxes. And we're going to divide that by our 40% contribution margin ratio. So that comes out to $1,525,000 divided by our contribution margin ratio of 40%, and that equals sales of $3,812,500, and that's the answer for number 13. Okay, another formula. Lake Erie Pure Water sells bottles of water for $3 a bottle. The cost of each bottle to make is 75 cents. The company's fixed costs are $2,700,000 a year. What is the company's margin of safety given a sales level of $3,800,000? So again, do your calculation, stop the video. When you are ready, restart your video. Okay, number 14. Again, Lake Erie Pure Water sells bottles of water for $3 a bottle. Each bottle costs 75 cents to make. The company had fixed costs of $2,700,000 a year. What's the company's margin of safety at a sales level of $3,800,000? So in order to do that, the margin of safety is equal to our sales, which we already have, the $3,800,000, minus our break-even point of sales. So step one, we have to go ahead and compute the break-even point in sales. And in this case, since it's break-even point in sales, it's our fixed cost divided by our contribution margin ratio. So our fixed costs are $2,700,000. And we divide that by our contribution margin ratio, which is $3 selling price minus the 75-cent variable cost divided by our selling price again of $3. So now we have $2,700,000 divided by a contribution margin ratio of 75%. At that point then, when we do the math, it's then $3,600,000, which is our break-even point in sales, but that's simply our break-even point. We're not done yet. Now we have to compute the margin of safety. So we take our sales of $3,800,000 from the description in our problem. We subtract out our $3,600,000 break-even point, and we find out we have a $200,000 margin of safety. Now let's talk about another aspect of cost volume profit analysis called decision costing. And decision costing, we look at costs and benefits, and we have to decide when we make a decision, there are a series of costs and benefits, some of which are relevant to our decision process, and then there are some that are not relevant to our decision process. So the first thing we have to be concerned about in decision costing is identification of those factors that are in effect relevant to our decision process. So when we're looking at cost and benefits, in order to be relevant, the cost or benefit has to be, number one, expected to be earned or incurred in the future. In other words, present and past cost don't really matter. It's what happens in the future that matters in terms of, based upon what decision we make, what are the benefits or costs that are going to be incurred. Okay, it's also only relevant if that benefit or cost differs amongst alternatives. If we have two alternatives where the benefit or the cost, individual benefits or individual costs are both the same, they're not really relevant because they're the same, so they don't differ between alternatives. We can ignore those. They're just clutter. Number three, relevant costs are also costs that can be avoided based upon the selection of one or more alternatives. We call these avoidable costs. So if we make one decision over another and we can avoid cost with that second decision, that's relevant to that decision process between the two alternatives. The last area is benefits that will be sacrificed because of the choice of one alternative or another. This is called an opportunity cost. Now, when we look at costs, again, in terms of relevant versus non-relevant, it also helps to determine or basically understand what are not relevant costs, okay? Obviously, those that do not differ among alternatives, and we talked about that really as being one of the qualifying costs where they differ among alternatives to be a relevant cost. Again, costs that were previously incurred and cannot be changed by any decision amongst the alternatives. These are called sunk costs. Sunk costs are never a relevant factor in decision costing. Also, if we have future cost that were previously committed, it cannot be avoided whenever the decision is taken. So these are called committed costs. Now let's look at a couple of decision processes regarding CVP analysis. This is an example of the decision process for a special order. Okay, whether we should either accept or reject a special order. And there's basically two major circumstances in a special order decision analysis. First of all, we have to decide if the company has excess capacity. In other words, does a company have the capacity to also produce this special order without having to give up any type of present production? Okay, now if the company has excess capacity, we follow one decision process. On the other hand, if the company does not have excess capacity, we have some additional considerations. So let's go back up to the top of if a company has excess capacity. The general rule is we will accept that special order if the minimum selling price exceeds all the variable cost associated with that special order. And remember, we can actually calculate that. We can take selling price, SP, minus our variable costs. And that will then equal our contribution margin. That's a C and an M there. So what it's saying is if the contribution margin from our special order is positive, we would want to accept that order, given nothing else is changing. Now, another thing is, even if we have a positive contribution margin, a special order may be rejected if it affects the selling price of regular sales. So if you were out selling a product for $20 a unit and somebody comes in and says we'll buy it for $10 a unit and you accept the order, your existing customers hear about this order and say we no longer want to spend that $20 a unit, we want you to lower it to $10 a unit. Overall, that would have a negative effect. Now, the second rule here is if for some reason, if as a result of that special order, if fixed costs are increased, we'll accept the order if the contribution margin along with the volume from the special order is sufficient to cover the increase in our fixed costs. Now, if the company does not have excess capacity, that's an indication that if we accept this order, we're going to have to give up existing productions. One or the other has to go. So basically what we're going to say here is, in addition to the considerations above, if the company does have considerations, if the company has excess capacity above, okay, then we have to consider the opportunity cost of sacrificing current production at whatever contribution margin it produces to fulfill the special order. So if the contribution margin of the current production exceeds the contribution margin of the special order, we would not want to accept the order because we would be giving up current production with a higher contribution margin than accepting that special order that would give us a lower contribution margin. That would have the effect of lowering overall net profit. Okay, question number 15 is a decision that has to be made based upon a special order. So we're going to apply cost, volume, profit decision processes to this special order. Should we accept the order or should we not accept the order? Now, a company is approached by an agent who represents a buyer who offers to purchase 10,000 units of production at $8.50 a unit. Now, some companies hire a purchasing agent or an independent contractor who goes out and does performs purchasing processes for them. They'll go out and get the bids and so forth, or there may be, they may have a specialty in terms of the product that the customer wants to buy or so forth. But sometimes companies will hire an agent to purchase items for them. Now, if we accept the order, the agent is entitled to receive a commission, and there'll be 50 cents a unit, and that will be paid by the seller, in other words, us. The company has sufficient capacity to accommodate the order. So in other words, we don't have to give up any other existing production to accommodate this order of 10,000. Also, the sale will not impact the current market selling price for the product. So we don't have to worry about the overall selling price for our product to be impacted. We're given the sales and cost structure here. We're given basically at a production level and sales level of 100,000 units. We're given all the costs associated with those units, and you can see that under total. Then we come up with a per unit cost where we take the total cost and divide it by the 100,000 units. And you can see that our selling price is $10 a unit. We know that for a fact. We know our cost per unit of producing it, and we know our total expenses are $9 a unit, leaving us an operating income of $1 a unit. So our dollar selling price results in operating income of $1 a unit. Now we have some additional information here. Variable costs include direct materials and direct labor, and in this case, factory overhead. These are all considered variable costs. Typically, you can pretty much be assured that in any problem, all direct materials and direct labor are variable cost. Factory overhead may be fixed, or it may be variable, or it may have a component of fixed and of variable. It depends upon the problem. Fixed costs include selling expenses and administrative expenses. Most of the time, those costs are fixed, but be careful. There can be variable costs, especially in the area of selling expenses. Now, what is the amount of the net incremental benefit or cost that will be incurred if the company accepts this special order? So we're given a little bit more background. If we take a look, according to our cost schedule here, it costs $9 to produce an order at a volume of 100,000 units. Yet the agent buyer is only offering $8.50 per unit selling price. So if we take a look at this at first glance, it's $8. Would we want to accept an order at $9 cost that we're only going to make in terms of selling price $8.50? Well, we have to, in order to actually do the calculation, we have to go through an incremental basically analysis here. So again, you're given some answers. Go ahead and do your calculation. Stop the video, and when you're ready, restart your video. Okay, now let's take a look at problem 16. This is cost, volume, profit analysis, decision making. But in this case, instead of accepting special orders, we're talking about a make or buy decision. Excel makes computer chips used in one of its products. Unit costs for the computer chip based upon production of 20,000 chips per year are, and we have our unit cost at 20,000. Direct materials of 9,000, direct labor of $9 per unit, direct labor at $5 per unit, and variable overhead at $1 per unit and fixed overhead at $13 a unit. That makes our total unit cost at a volume of 20,000 chips. It costs $28 to make a chip. Now, an outside supplier has approached us and is offering to provide all the chips at the cost of $25 a chip per year. Now that looks kind of lucrative because our current cost to produce is $28 a chip, and they're going to be offering us $25 a chip. So the question is, should we accept that type of outsourcing deal? Now, the company has just remodeled this year the production facility at a cost of $150,000. Based upon market studies, if they did outsource that production to this outside supplier, this third party, they could go ahead and lease now the idle production facilities for $25,000 annually. So kind of an added bonus. So the question then is, what is the net benefit or cost if the company chooses to outsource the production of the computer chips? And you're given net benefits and net costs. So go ahead, do your computations, stop the video, and when you are ready, restart your video. Okay, let's take a look at the answers to number 16. The answer, by the way, will be C, net cost of $175,000. Now, in this case, again, what is the net benefit cost if the company chooses to outsource the production of the computer chips? Okay, the first thing we need to do is look at all the costs that are associated in this problem and decide whether they are relevant or not relevant. So the first thing I'm going to do is basically identify the non-relevant costs. Okay, the first thing is my fixed overhead is a non-relevant cost because my fixed overhead is a fixed cost. It's not going to change with the volume change. Okay, now the second item that is a non-relevant cost is a remodel of the production facility for $150,000. That is a cost that has already occurred, therefore it's a sunk cost, and sunk costs are never relevant in cost, volume, profit decision making. Okay, now incremental benefits. The incremental benefits and also the incremental costs. So let's start off with the incremental benefits. Okay, the first thing we're going to do is we're going to avoid our production cost, which include the $9 direct materials, the variable cost of $5, and the $1 variable cost of overhead, which total to $15 in variable costs. So $15 variable cost of production times our volume of 20,000 means we can avoid $300,000 of production costs. In addition, since we're going to have an idle facility, we're going to be able to lease that idle facility for an amount of $25,000. So the future benefits, or the benefits that we're going to earn or incur, will be $325,000 if we decide to outsource the production. Now let's take a look at the incremental cost associated with the production. And again, I'm going to do the calculation up here. The outside supplier says they will supply the computer chips for $25 per chip. That's our variable cost. We're going to multiply that times the volume that they're replacing, which will be 20,000 units of volume. If we multiply those two together, they end up being $500,000. So we're basically going to incur $500,000 of cost by buying it from our vendor, or for this proposed vendor. So now we take the future benefits incurred of $325,000 and we compare that to the future costs that we're going to incur of $500,000. And the net cost, in this case, we're going to have a net cost of outsourcing of $175,000, which is our answer.